Welcome back to Fast Market here on the Schwab Network. It's time for cash tags. For that, let's bring in our next guest. That's going to be Andy Swan, co-founder at Likefolio. Welcome back to the show, Andy.
Thank you.
All right, so we're talking CAVA. They got 323 restaurants, Andy. The market cap of this company is $12 billion. That's equivalent to about $37 million per outlet of CAVA. I mean, I get it. It's a growth story. The stock's at all-time highs. Do you guys have the data that kind of lays out this plan that this company's worth this much?
Well, that's a big ask because that is a big valuation. It's really difficult to get there, but the stock is certainly on a growth trajectory. Consumers like what the company is producing. Likefolio data is very clear that CAVA is outperforming its healthy, fast casual peers, Chipotle and Sweetgreen. When you look at the change in web visits year over year, CAVA is really the only one positive at this point. Even Chipotle pulling back a little bit at 1%. CAVA showing great growth. A lot of that is, they're able to put out more stores. People are discovering the brand and they like what they see. Overall, I think CAVA is in a pretty good niche where you can generally absorb and pass on those food price increases to the customer without too much pushback. And so, look, I can't defend the company's valuation on the basis of the number of stores it has today. But if you compare CAVA to the number of stores that Chipotle has, the growth story is certainly, very credible. They could double, triple the amount of stores next year and not put a dent in the number of healthy, fast casual options that are out there. So I think, this is the classic value versus growth play. We'll see which one works. But from an earnings perspective, we think CAVA is showing all of the signs that revenue will continue to move higher and profits will follow.
Andy, it's tricky for two bald meatheads from the Midwest to talk about CAVA because it's not in the Midwest. It's in the East Coast, Texas, Oklahoma, a little Southern California. But the fact that, they're expanding by, it was 48 to 52 per year. They just raised that to 50 to 54 per year. You're right. The earnings the PE ratio is elevated, but the growth of this company, and here's what I like about it, Andy. They're one of those companies that have their stores, but sell their products in grocery stores as well. Yeah. So they get that dual income stream from not only their food, but grocery buyers. But this is just a pure growth story. Long as the growth stays up, long as they see an ability to open 50 plus stores a year, then whatever PE they have is justified if they're growing like that, Andy.
Yeah, when we look at web visits up 22% year over year, that's really an indication of more people discovering the restaurants. That's a result of stores opening in their area and word of mouth on the quality of the ingredients and the product that the company's putting out. So that's always a good story. They're doing a good job of capturing people into their loyalty programs and into their app usage. That's up 40% year over year, which is a little bit down from where it was last quarter, but still very robust growth. And so it's really just comes down to, from an investor's perspective, do you think that the company can continue to execute as they add 50, 55 stores per year? It's a very different business to run a company with 300 stores than 2,000 stores. And so at what point does that growth curve start to throw some problems in the way of revenue growth? I think that's the question that investors have to answer, because from, Likefolio perspective, we are looking at what the consumer thinks about the company, and all signs are that the consumer that is going into and has access to these stores really likes the product and becomes a very loyal customer, which is exactly what you'd want in a growth story like this.
Yeah, and Kevin, we've got one in Wicker Park, and we've got one on the North Shore. So there's a couple locations, and there's a new one.
Oh, I didn't.
Yeah, and there's a new one opening up at the end of the month, closer to you, out in the burbs. But Andy, when you look at this, they're trying to mimic that Chipotle story, right? They expect to have 1,000 restaurants by 2032. Do we have like the happiness numbers that are comparable with maybe some of its competitors, or maybe it's better, and that's why the stock's at all-time highs?
Yeah, it's better now because Chipotle's has pulled back a little bit. Some of the portion size controversy got Chipotle a little bit caught up, but CAVA customers are very happy. There's no doubt about it, and they seem to be telling their friends about their experience or taking friends to the restaurant, which I think is a really great sign. Last quarter the company put up great revenue numbers, good earnings numbers. They beat on all metrics. Same-store sales were a little bit light. The stock took a little bit of a dip, but then ran the rest of the quarter. I think that's the type of playbook that I would be looking for as an investor or a trader in this company is, if they continue to put out those good growth numbers and beat expectations, but the stock pulls back, that can be a really nice opportunity, just as it was 3 months ago.
Yeah, last quarter, 29% increase on revenue over the last 12 months. But they did raise guidance as far as restaurant sales, even though same-store restaurant sales came in a little bit light on that quarterly number. What's the earnings score on this one, Andy, with the stock at all-time highs?
Yeah, with the stock at all-time highs and, a massive amount of growth in the stock, I think that we get a replay of what we saw last quarter. I think we could see a pullback on really good numbers. And if we do that, I would see that as a medium to long-term opportunity.
All right, great stuff, great data. As always, Andy, appreciate it.